You walk into a branch, hand over a paycheck, and assume your money is sitting safely in a steel vault waiting for you. But modern banking operates on a totally different principle. The moment your money crosses the counter, it enters a highly leveraged system designed to generate billions of dollars in profit every year. Consumers naturally wonder how they get free checking accounts, free digital apps, and free ATM access. Running a national financial network costs a fortune, yet banks rarely charge you to simply hold your cash. Legally, a deposit is not a neatly wrapped package placed in a personal lockbox. When you hand over your cash, you are actually giving an unsecured loan directly to the bank. To pay for their overhead and satisfy shareholders, banks have to put that money to work. They take the cash you lent them and immediately pump it back out into the broader economy at a markup. The entire business model relies on a high-wire balancing act. Banks try to maximize their revenue by pushing out as many cash assets as possible, while carefully managing the constant liability that their customers might ask for their money back all at once. This diagram illustrates a standard $10,000 customer checking deposit landing in a bank's ledger. This single block of cash acts as the raw material for the institution's profit engine. To maintain your business, the bank pays a small yield for the right to use your funds. Let's say they give you a 1% annual return on your money. The bank turns around and lends your exact same $10,000 to someone else buying a house. But for that 30-year 7% mortgage, the revenue flows entirely to the bank. The difference between the 1% the bank pays you and the 7% they collect from the borrower is called the net interest margin. That 6% spread is locked-in profit. Institutions scale this up by fracturing deposits into higher-risk categories. They channel portions of your cash into auto loans, business credit lines, and unsecured credit cards, where the interest returns frequently exceed 20%. Net interest margin operates as a massive compounding mechanism. By capturing the spread between everyday savers and everyday borrowers, banks extract billions of dollars systematically across millions of accounts. Lending inherently carries the risk of default, so banks aggressively pursue daily operations that offer guaranteed, risk-free cash flows to stabilize their balance sheets. They levy fees for routine maintenance, charge for international wire transfers, and penalize customers with overdraft charges. These direct consumer deductions represent billions in pure annual revenue with almost zero overhead costs for the bank. At the institutional tier, Wall Street investment banking divisions operate on an entirely different scale of guaranteed income. Banks act as brokers and deal makers for corporations. When two multinational companies merge or a tech startup goes public, the bank structures the deal. They take home hundreds of millions of dollars in advisory commissions without having to tie up a single dime of their own capital. Merging the high-yield returns of consumer lending with the zero-risk advisory fees of Wall Street deal-making creates a highly diversified, economically resilient financial empire. But the defensive side of the balance sheet is always vulnerable. Borrowers inevitably lose jobs, businesses go bankrupt, and loans fail. Banks plan for these localized losses. They run mathematical stress tests and divert portions of their net interest profit into massive capital reserve pools designed to absorb the hits. A localized wave of bad mortgages hurts, but it is rarely fatal. The true existential threat to a bank's survival is a sudden, volatile shift in the underlying cost of money itself. That cost is dictated by the Federal Reserve. By setting baseline interest rates, the Fed determines exactly how expensive it is for banks to borrow and lend cash. For roughly 14 years following the 2008 crisis, the global financial system operated in an age of easy money. The Fed kept rates near zero, lulling financial institutions into a false sense of perpetual stability and encouraging them to take on massive leverage. The entire banking leverage machine is perfectly calibrated for profit, but it requires the Federal Reserve's underlying interest rates to remain predictable. When inflation soared, Federal Reserve Chair Jerome Powell initiated aggressive rate hikes at the fastest pace in decades, severely shocking the financial system. This graphic demonstrates the double-edged sword of those rate hikes. While a bank can charge more for new loans, the older, low-yield government bonds they already hold plummet in value on the open market. Silicon Valley Bank failed to manage this exact tension. As interest rates spiked, the value of their massive, seemingly safe bond portfolio fell below the total amount of money they owed to their depositors. When tech startups and venture capitalists realized the math no longer worked, they panicked. They digitally withdrew their deposits faster than the bank could sell off its depreciated assets to cover the cash. The system is a strict duality. It is a highly efficient, compounding profit engine, yet it remains incredibly fragile and entirely subservient to the broader economy's vital signs. And now you know how banks turn everyday deposits, loans, fees, and interest rates into a multi-billion-dollar business.